If I stop, does it pause it? Do we have to start all over again?
I'm thinking, yeah, you want to keep it live right now.
I do.
Yeah, you can just say you don't, if there's someone that comes down and say, tell them that you started with it.
Oh, are you checking it over there to see that you're on?
I'm sorry? Double. Okay, then 1, 3. So D-O-U-D. Yeah. It's plugged in there. Okay, and if you're able to comment, can you comment? Hold on.
What do you see on the screen here? Okay, and do you see on the screen?
No. Oh. What do you see on the screen?
We had as kids. We had to. We had chickens had 2 or 3 that we turned in. See one has orange ticket. On the electronic side, Especially the kids.
No.
How do you know? How do you know
You're
they're
live.
hear you?
You're live.
Can people hear you? Are you live?
You're live. You're live. So, and right now you're not sharing the screen, so you're basically just.
How do you know I'm not sharing the screen?
Because I checked.
Okay.
And what we saw on the is you have the piece of paper over the camera, so we can see half of it. So.
Where do we see all of our great people who are on our attendees?
You should be able to see that on here. If you just kind of minimize this one. And you can also so you'll just do that, and I'm going to share your screen.
Okay. So the only thing that's live right now is the camera making. Yeah, I can see my buttons.
Yeah, exactly.
Cool.
Start.
Oh, because it's me.
Okay, start. So let's see if we can.
So the sound is really muffled. Okay. I do have a speaker we can use to a microphone.
My headphones.
Yeah, well, I have a microphone. We will get started here in just a second. This is our first Google Hangout, so thank you for joining today. We do have a piece of paper over the screen, that's why it's real cloudy. And I'm using a different microphone. Hopefully that sounds better. All right, I think we are starting. It says we are just about. Okay. I'm already in a video call. Do I take me there or end the other call it's asking? Take me there, okay. Oh, it's taking me to the other video call. It says now I can close this window. Is that okay? Okay. Now what do I do? Start again?
So make sure we don't have.
Okay. And do I start this now? Again? Okay. I did that as. Okay. Do this again. You're already in a video call. Take me there or join the other call.
Should be.
And then I close it and we did the exact same thing last time. So we're going, kind of going loop. We keep doing the same thing over and over again. So if I close this window, then we start all over again.
Yeah, let's start
See that?
over again. And then let's just keep.
Okay, so I think they can see us. I think they can see us. Or join the other call. Oh, now I see myself. That's delayed. I don't know. I'll start again. All right, we're working on technical difficulties trying to get in. Thanks for your patience. We're working on it. Okay. I don't know what to do. We're going loop to loop over and over again. We're doing the exact same thing. I have somebody. Okay, yes, that's better. They keep
Another.
Close this. I don't know what that is. That's video. It says it's live, but
Okay, what I want to do is let's go back here. Let's close it out. Close
the whole thing.
Let's close it up. Close it out.
I think we got it. Now, how do we know? Let me check somebody on my other line. Hey, everybody, this is Chris Abeyta. Thanks for your patience. We're going loop to loop trying to figure out how to get this started with Google Plus, our first hangout. So, Terry Grooms, I know you're on. Would you, if you're getting this, would you text me real quick and let me know if you see my screen? The PowerPoint should be a PowerPoint with my name on it. And I don't know if you're seeing video, and I don't know if you're hearing as well. Ha! You can see me. Okay, Terry, can you also see the PowerPoint as well? Terry, can you see the PowerPoint as well? Let's see. I guess, Terry, I could just call you. You can see me. I can't hear you. So I'm just going to exit out of the power. Well, let's see if they can see it. Oh, okay, so exit out of the PowerPoint? Okay. Can you see the PowerPoint or my screen?
No, I can't see anything. It looks like this is like a paper over. I can hear you in the background, but it's just showing just cloudy.
Okay, because we're actually live now. That's an older recorded.
Yeah.
You're watching something that's older and recorded.
Okay. Because I'm not seeing any PowerPoint at all. Okay, I see a picture.
You see my picture?
Of you with your headset on.
Oh, they see my picture of me with my headset on.
Okay, now it's gone.
Now it's gone. Okay.
That's back.
Now it's back.
what I would like to do is if they could just close out of that and come back on to the live. They can just close out. They can just close out of that.
I'm being instructed to instruct everybody to close out of what you're seeing, which is a recording, and then go back into Google Plus.
Yep.
Do the same process to try and catch what's live, because I think what you might be watching is a previously recorded attempt to figure out what we're doing.
Okay. I went out and came back in. Yep. Yep. I can see your PowerPoint.
Okay, now you can see my PowerPoint.
And I can hear you.
Real time.
No,
Might be delayed a little bit.
yeah, I think it's delayed.
Okay. So, Mr. Producer, can we find out if there's other viewers on that we need to help? How do we know who's on? We've got 5 viewers. Hopefully they can see, and hopefully they're seeing the right thing. That's our hope. You can, or you want it to? Okay, good. I think we're good. Thanks, Terry.
Yeah, you're welcome.
Okay, bye. All right, everybody. Hey, thanks for your patience. First time doing a Google Hangout. I've got my friend Chris helping me out with that, another Chris. So today we are going to talk about different types of annuities, how they fit into your overall retirement plan. So thank you for joining me today. Let's take a look at a few things, what we're going to cover today. I do have books that I want to give away, so if you're interested in a book, you are welcome to come by the office and pick that up, and you can use it for yourself or share it with a friend. It's Retirement Confidence in an Uncertain World. I wrote it last year and published it. It is also on Amazon. You can get an Amazon Kindle copy as well if you go to Amazon.com. Today we're going to talk about the different types of annuities and really go through some pros and cons on different types of annuities. There are lots of different types, and we'll go ahead and dive into these. The first type are immediate annuities, and sometimes these are called SPIAs, and that stands for Single Premium Immediate Annuity. And we'll get into those. We're going to cover variable annuities, fixed annuities, indexed annuities, and what some people are calling hybrid annuities. And you might see a lot of this out on the website or on the internet talking about hybrid annuities. And then the next question is how to use the correct annuity to secure your retirement. What fits you best? And so there's lots of different kinds. And one thing I've learned is there's no perfect financial tool and there's no perfect financial instrument. So it's really about customizing what it is that you need to your specific retirement strategy or financial strategy and finding the best tool that's going to be the best to meet your needs and your season at the time. And so one thing that might be the best for you might not be the best for someone else. So that doesn't mean like there's a champion tool out there. So let's take a look at the first one. This is what most people think of when they think of annuities, because this is the first really type of annuity that's been around for a long time, and it's the immediate annuity or the single premium immediate annuity. And what that means is you give a lump sum or a chunk of money over to the annuity company, the life insurance company that's running the annuity. What they then do is they will then, in exchange for that money, they will send you stream of income payments for, it could be for your life, it could be joint life for you and your spouse, it also could be for what's called period certain, which means we're going to do this for 10 years and that's it, or 20 years and then after that it's done. And so whatever you choose, they're going to calculate that out. Now this is also the annuity that in some cases may have gotten a bad rap, or maybe this is where people maybe hated annuities. And I've got a phone call. Would you take that? Because I wonder if it's somebody trying to get on.
Hi, this is Chris answering for Chris.
So is it a Google friend? Yep.
Yes, it'll be recorded, so we'll push that back out. They're asking to be recorded. You can catch it.
Okay, great. And so we are recording this so you can catch it another time as well. So here's where these may have gotten the bad rep when people say, I hate annuities. There's really two that I can think of why people would hate them. Number one might be this one, and here's why. If you did a single premium annuity and you told the life insurance company, send me payments for as long as I'm alive. Well, that works if you live a long time, because eventually you're going to get all the money that you gave the insurance company back, plus interest. And then if you live a long time, you're going to start getting the insurance company's money, which is good for you because you basically ran out of your money and now you're living on somebody else's, which is the insurance company. They're guaranteeing that. However, if you start this process and 2 or 3 years later you pass away before you get all your money back, in this case, if it was a life paying annuity, well, they paid you for life. And if your life got cut short, then the risk is the insurance company is going to keep the rest of that money because they were betting that you would pass away earlier. You were betting that you lived longer, and therefore they got to keep the rest of the money. So that's where annuities have come a long ways. These are still useful. Where these are useful is if you know that you are retiring right now, you want a stream of income, a steady stream of income for a certain period of time, or you just know that you're going to live a long time. They're pretty inexpensive. They have some tax advantages because they're only going to charge you taxable on the interest that's blended all the way through or amortized all the way through the payments, because most of the money coming back out is your money. Unless it's an IRA, then that would be taxable. So these annuities have been around for a long time, a couple thousand years. These annuities were used back with the Roman, during the Roman Empire. Soldiers would give money to the Roman government in exchange for a lifetime stream of payments. If they got killed in battle, please send my family money and send payments back to my family. So this is the first set of annuities, or first type. It's called the single premium immediate annuity. The cons are, let's see if I've got, yeah, the cons are if you pass away early, then you don't get all your money back. The other cons right now are there are low interest rates, and you're not going to get a lot of interest blended in there, so the majority of the money coming back over the time is going to be your money until you outlive your money, and then they start sending you their money, which can be good. This is for, you need to be ready to take income now. You can't put it in and then defer it for 10 years and then decide to take it. And possibly you may leave nothing to your heirs in this situation. The other part is when you do a single premium immediate annuity in exchange for payments, what's happening is, let's say you give $500,000 and you give that over to the insurance company. It is that $500,000 no longer on your balance sheet. So it's no longer your asset. You've basically given it over in exchange for payments, just like a Social Security check. You've been putting money away into the Social Security Administration maybe all your life, and now you have a Social Security check. You can't count how much money you put away as an asset. So once you do that and you annuitize this, it's no longer on your balance sheet. There are certain things you can do, though, to make sure that you do get all your money if you pass away early, and you can say, I want this for a period certain. So let's say you say, I want this money for 10 years, period certain. They will pay you for 10 years even if you die. If you die in the first year, you die in the first month, you die after the first payment, they're going to continue to pay you all the way through those 10 years because it's period certain. It's for sure that they're going to pay. And if you pass away, they'll end up sending that to your beneficiaries or your heirs. Let's take a look at the next annuity. The next one is called a fixed annuity. Now, the way a fixed annuity works is usually it's deferred. You can put the money in. You don't have to start taking payments out. You can just let it grow. The powerful thing is your principal is protected from losses, and fixed is that key word there, is your money is protected. You can't lose any money because it's fixed, and it's based on the claims paying ability of the insurance company. And usually insurance companies, life insurance companies, are very, very solid financially. And there's a lot of backups. If one life insurance company looks like it's having problems, usually other insurance companies will pick it up and either take it over or infuse capital into it too. It's not like a bank. Insurance companies, life insurance companies, don't go out of business very often. It's very rare. So your principal is protected from loss. Now, the growth on a fixed annuity is based on interest rates. It's kind of like a CD. You put the money in, and based on the interest rate of that time that the insurance company is paying, that's how your calculation or your account is going to grow. Now, what's better than a CD is your account is going to grow tax deferred. So when you have a CD, and let's say you're making 1% these days, or let's just be generous and making 2%, at the end of the year, you're going to get a 1099 for interest, and you're going to be taxed on that in a CD. However, in a fixed annuity, you are not going to be. The gains and the growth are going to pile up and compound inside the annuity, and you will not be taxed on it until you take the money out or take the growth out. So it grows tax deferred, and it gives you something called triple compounding. This is an opportunity for your money to compound on the principal, the interest can grow on top of the interest you're gaining year after year, and then because you're not being taxed, you can actually grow on the tax you would have paid. So it gives you the ability to accumulate a lot faster than a CD. However, we both know interest rates are really low. So here's the cons. We're in a very low interest rate environment right now. There's a lot of low growth. It's not a great place to put money right now unless you want maybe a little bit better returns than a CD, and you want to put it in a little bit longer than a CD, and maybe you want it safer than a bank, because life insurance companies typically are much safer than banks, though the public usually doesn't know that. Life insurance companies have to have a very high solvency ratio, over 100%, which means if they had to give all their clients money back, 100% of their clients would get their money back, and there'd be money left over inside the life insurance company. So that's one option, whereas a bank is typically about 3% solvent. So if everybody went to the bank today and said, I want my money back in cash, excuse me, you'd probably have about 3% of the people getting their money back. Okay. Want to make sure everybody's able to see the slides, so we're just doing a double check here. And I'm going to have, let's see, Terry, if you would let me know. Nancy, you can see. But I have been changing slides. Colorado Pack Rat, Nancy. Okay, so I see we're missing the slides. Well, the slides have been what I've been saying, so there's no exciting pictures on there, but let's see if we can get the slides working. Without full screen, okay. All right, we're going to a variable annuity next. Let's take a look and see. And I am getting your messages now. They're on my phone. So if you want to respond, let me know if you can see slides now. And if you can't, we'll be happy to provide the slides to you. You're good now? Okay. All right, we're just going to scroll through slides here. You think Google would have this. Is this a Google error, or is this a Chris Abeyta error? Or a Chris Perez error? It's got to be a producer error. Thank you very much. So you are seeing it. Okay. And by the way, my phone just popped up, and I'm actually seeing your responses, and I'm seeing your questions. So feel free and send those to me, because I can get those right now. Looks like those are coming in. All right, Terry, thank you. See that. All right, let's talk about variable annuities. A variable annuity is basically what's called a set of sub-accounts that are basically mutual funds wrapped inside an annuity wrapper. So why would you do this? Well, if it's not an IRA, what you can do is you can put money into a variable annuity. You can pick and choose from a bunch of different mutual fund type accounts, and as the market goes up, you participate in the up, and mutual funds, they buy and they sell, and they're trading on a regular basis. And so what you get at the end of the year, typically when you're outside of a variable annuity in a typical mutual fund, is you will get a 1099 with dividend and capital gain statements, and just like a CD, you have to pay the taxes on those every year. However, if it is inside a variable annuity, you're going to be able to get tax deferred growth, and you can compound your growth much more quickly and save the taxes for later on when you actually take the money out of the variable annuity. So what are the pluses? Well, you get the market upside. So in a market like right now, where the market is just screaming, it's going up. We just hit a new high for the Dow yesterday. If you're in the right mutual funds, you could really be participating in a significant amount of market upside. I already mentioned tax deferred growth. Now, the other thing that you can attach to a variable annuity is you can attach income riders or death benefit riders. So here's an interesting thing on a variable annuity. Let's talk about a high water mark. Let's say that your annuity, the accounts or the value of your annuity goes higher than it's ever been before, and then we go into a market crash, and your accounts drop 30 or 40%. Well, if you had a high water mark rider, you could actually, if you died, instead of sending your beneficiaries just what is in the account value, that's 50% lower because you took a big loss, they would send you the high water mark, which is the highest value that the annuity ever reached. So there's a death benefit attached to that you could, you're paying for this probably about a percentage point or more, maybe 1.25% for this life insurance benefit, and they would send your heirs the most the amount that is equal to the most amount of money that you ever had in the annuity based on the highest part of the stock market. That could be a benefit, a death benefit. It could also be an income rider where they would say, we'll calculate your future paychecks based on the highest amount the market has ever reached. So you can, those are riders that you can attach. They also have different benefit riders that would be maybe it grows at 5.5%, or maybe it grows at 6% guaranteed every year, regardless of what the mutual funds do, for an income account, not a cash account, but an income account. And at some point when you retire, they would then calculate your paychecks based on that certain amount, and then give you a paycheck for the rest of your life based on that amount. So those are some of the pros. Some of the cons of variable annuities are, I'll say this, I've never met one individual, and I've seen a lot of these, that ever understood what they actually had in a variable annuity. And when they bought it, they were not told really in detail what they have. And so I end up doing a lot of educating on what it is you actually have. And then people go, oh, well, that's not what I thought I bought. And so we have the ability in our office to use variable annuities and variable products like this, but we don't, especially when it comes to the income basket, because they're not as efficient, and there's much better tools to actually achieve more income than these. But what you do have on the upside is if the stock market is screaming and going up, you could make a lot more money in a variable annuity, but you can also lose your principal. Your principal is not protected, and that's why it's called variable. The value in your account goes up, and the value in your account goes down. The other challenge is typically in a variable annuity, the fees are between 3 and 5% annually. So this is a slowdown. It's like carrying a weight especially when the market's going up, but even worse when the market is going down. So when the market's going up and your let's call it your mutual funds inside the variable annuity are going up, let's say they go up 12% this year. Well, if you've got a 4% fee, you're only going to get 8%. If you've got $300,000 in this variable annuity, I've done this, for people before, is, show them what they actually have, and then you do 300,000 times 4%. You're actually paying $12,000 a year in fees just to hold the account and the different features the account has. And most people have no idea the fees inside their variable annuity because they're hidden. They're in different places. There's an administrative fee. There's the mutual fund fee, which is typically about 1% or 1.25%. Then you've got the rider fee, which is another 1.5 or 1.25%. Then you've got an administrative fee, a management fee, a death benefit fee. And so when you add all those up, you have to know that you're buying what you want. And if you've got a variable annuity and you want us to take have somebody here take a look at it, we can certainly do that and let you know. The other challenge is typically the income riders are static. So they're sold with the excitement that, hey, you can get 5 or 6% guaranteed every year towards your income. But once you turn on that income and you say, I want to go ahead and turn on an income stream, there's not going to be any inflation increases. It's just going to pay you whatever that predetermined amount is for as long as you are alive. Some of these income riders are joint, and you can do it for both you and a spouse. Some variable annuities do not allow them to be joint, and I've sat with several couples. When we looked at that, they realized that if the husband passed away, the wife was not going to get the income that was coming out, and therefore it wasn't covering both of them. It was actually putting the surviving spouse at quite a bit of risk. So you really have to dive in. There are a lot of different ones. The last one I think we got from a certain company, we actually got a copy of their prospectus and it was about the size of a phone book. It was about 400 pages long. So am I bashing on variable annuities? There's the place for them, but there's also not the place for them. And unfortunately, what I have found most of the time that people have them that I have seen, it's not the tool that they want. It's not the best tool for what they're trying to achieve. If it was, then it would be a good fit. But in many times, in many cases, it's not quite what they thought they bought. And it's not the most efficient for what they're looking for. Not always, but in many cases. The next annuity we'll talk about is called the fixed indexed annuity. And this is one, many of you who are our clients, you're familiar with these. You probably have these in your accounts now. But what a fixed index annuity does is it's fixed. You have the ability to index, and you can also turn on a lifetime income. So its principal is protected from loss. And this is what most people like about this is, back in 2008 when the market crashed 30 or 40, 50%, if you were in a fixed index annuity, you didn't lose anything. In fact, it was a great situation for you. And if I, maybe I can pull up a screen real quick. Let me know if this is, Chris here, if you're able to see this. This is how the fixed should have had this up earlier, but I'll pull it up here. Basically, the way the fixed index annuity works is when the stock market or the index, in this case, the S&P 500 goes up. Hopefully you can see this. Is it delayed? Okay. When the stock market goes up, your annuity has the ability to gain in value because it's indexed against a certain index. It could be indexed against the S&P 500. It could be indexed against the Dow. It could be indexed against the Russell 2000. You name it. There's all different kinds of indexes that you could index against. So the powerful thing is you get upside participation in the market. Now you're not going to get all the upside of the market, but you're going to get some of the upside of the market. But when the stock market crashes and goes down, you're going to get none of the stock market losses because the money that you have in the index annuity, it's not actually in the stock market. They're actually trading options on the market to achieve gains but never participate in principal losses. So your principals is protected, and that's the powerful thing. So I don't know if you can see it, but can't see that. Okay, so we'll just stick with the PowerPoints that we've got here. So that's the powerful thing. The other thing is your gains are locked in. So every year that you actually make a gain, your gain is locked in, never to be lost. So your principal can increase, and if the stock market crashes the next year, it doesn't have any impact on any of the gains compared to a variable annuity where you might have a really good year one year and make 12, 13, 14%, but if you lose 30% the next year, you've lost all your gains and some of your principal. Whereas with a fixed index annuity, you can never lose your principal due to a drop in the stock market. And a lot of people like that, and that's called an annual reset. So every year your gains are actually locked in. That's your new principal value, and it goes from there. The other pros about fixed index annuities, they tend to have lower fees or no fees. And it depends on every company's different. Every setup is different. But because there are not mutual funds inside, there's not a mutual fund manager, there's not as many moving parts, they basically can track it very simply and easy. There's a lot fewer fees involved. And so some of the tools that we use average from no fees every year to maybe 0.7% or 70 basis points, which is 0.7 of a point, or maybe up to 1.05. So there's not a lot of fees in these tools, which is nice, which allows your principal to be protected and to continue to grow. What are some of the cons? Well, some of the cons are you're not going to get all the market upside. So in a market like right now, where you might be seeing, last year the S&P did 30%, you probably got a lot less in your account. And also your growth may be capped or it may be based on a spread. So when the market goes up, your growth is going to be limited. And there's a lot of different strategies that you can use to try and overcome some of the limits. We've seen some really strong returns this year because of some of the strategies that we used to achieve higher returns without any risk to principal loss. So that's the other part is working on the different strategies that are available. So those are some of the cons. Is you're just, in a market like this, you're not going to get all the upside, but when the market corrects or when it goes down, you're going to get none of the downside. And so it's balancing between what fits best for you. Now let's talk about this last type. It's called, a lot of people are calling it a hybrid annuity. And I'm going to explain what that is. A hybrid annuity is basically a fixed indexed annuity with an income rider on it. So it's what we just talked about. Your principal's safe. Your growth in your account value is based on the market going up and you participating, locking in your gains on an annual basis, on an annual reset, and that being your new principal. But you can also attach something called an income rider that allows your income for retirement to grow while it's in deferral. So there's different types of income riders. So that means that you've got two accounts. One account is going to be the account that is based on the stock market going up or staying flat but not going down. That's your cash accumulation account. The other account where an income rider comes into play is, let's say that you're concerned, well, gee, I don't know if the stock market's going to do anything, or it could go down for 10 years or it could go flat for 10 years. Many companies will give you a guaranteed income rider where they'll say, you know, we're going to guarantee 6.5% or we'll guarantee 7% towards an income account. And it's an accounting account that allows the amount that we're going to determine your paychecks on in the future to go up, 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 up. And then when you need those paychecks, they're going to calculate which is higher, the cash accumulation account or that income account that's been going up at a steady 6.5% or 7%, and then turn on your paychecks based on that. So that's the nice thing, is you can actually guarantee what your future retirement is going to be regardless of what the market does. And so it can be a very nice, powerful tool, especially for people that want to feel some guarantees and some confidence in what their forecasts are. There's other types of guaranteed income riders that may not guarantee a certain interest percentage, but they may guarantee, let's say that in your cash account, the annuity or the index makes 5%. Well, you might get a bonus on top of that, and they might give you 7% towards your income account that year. So there's different ones and different ones to look at. The key is which one fits you, and that's identifying and finding which is the best one that's going to fit your season, your plan, the kind of security that you want going into retirement. And that's the nice thing, is you can actually predetermine retirement. So now some of the cons of hybrid annuities, they can be complex because they have multiple moving parts when it comes to the income rider and how they're generated. You're not going to get all the market upside, but you're more designed for income and principal protection. So these tools really are designed to help you project what your future income is going to be in retirement, to give you some security in that. And that's the key. It's more about thinking about a pension and what your income is going to be, not the amount that's going to be in your account. And so it's different. You know, when somebody asked, back in the days when we had a lot of pensions, people would say, tell me about your pension. And people would say, oh, I'm going to get $3,000 a month for the rest of my life. Okay, that's how you value a pension. Then we moved to 401ks, and now people say, well, tell me about your 401k. And you don't automatically go, well, my 401k is going to generate $3,000 a month for the rest of my life, because you have no idea. Instead, we measure it with a value saying, well, I've got $500,000 in my 401k. Okay, well, those are two very different valuations. The question is, which valuation is more important to you? How much income you're going to have or how much money you have? And for different people in different seasons, it's different. With the hybrid or the fixed index annuity, the hybrid here, it's more about the question of what kind of income is this going to generate for you and your spouse as long as you live. And so that's what you have to be thinking. It's a different mentality of shifting over to an income mentality. The other cons can be that sometimes they can have long surrender periods. I've seen some of these. We don't offer these, but some of these with 20-year surrender periods, which is just crazy. And so you want to look for something that is going to fit the time that you may not access that money or when you start retiring and drawing a stream of income from that. The other thing that you want to look at is, let's talk about how to avoid the wrong annuity, pros and cons. We've talked about some of the pros and some of the cons of each different type of annuity. Probably the most powerful way or most important way to find out if you have the right type of annuity or which one is the type for you is really to be considering some of these things here. Number one, fees. What are the fees on those annuities, and how is that impacting your account value? If fees are very, very high, you better be getting a lot for it. And in many cases, I've seen you're not, especially in the variable annuities, you're not getting what you're paying for. A lot of times you can get the same thing or better for less fees. The other question is safety. Do you want your principal to be safe, or are you okay with it going up and down? And that'll determine what kind fits for you. Protection. Do you want protection from market downside? Do you also want protection from income fluctuation? Those are questions to ask. And income. Are you buying it for income in the future, or are you buying it simply as a holding place for your money to grow and then decide what to do with it later? So if that's the case, then you don't need an income rider. You might just want the most growth potential that you can get out of it and then decide what to do with it later on. So it's all about your season and your planning. The other thing is inflation growth, and this is interesting because there's only, I know of, one, maybe two companies that really do an inflation adjustment. So here's what I mean. Most annuities, when you turn on a lifetime stream of income, it's going to be static, meaning if you turn on $3,000 a month, you get $3,000 a month for the rest of your life. The challenge might be you might be retired for 25 or 30 years. And in 20 years, $3,000 a month is probably going to be worth about $1,500 a month in its buying power. So that might look really good now, but it's going to look really poor in the future. So you need to think, are there other tools out there that maybe I can turn on $3,000 a month today, or maybe it's a little bit less, maybe it's $2,700 a month today, but 20 years from now, it will be $6,000 a month because it's going to adjust with inflation. That's really important. And when you add those up and you put those side by side, you're going to find that some annuities, this is very important, some annuities potentially could pay you $300,000 to $400,000 more over your expected lifetime than another annuity. And so you have to look beyond what's it going to do today or in my retirement year when I first start, all the way 20 or 30 years through retirement. So you don't just plan to get to retirement, you got to plan through retirement. It's kind of like not just planning for the marriage or the wedding day, but planning through for the entire marriage. You got to plan through retirement, not just getting to retirement. So the question is, where do these fit in your overall plan? And if you have sat with us before, you've looked at you've seen this before. This is our different stages of life stage financial planning. We've got the accumulation phase, the retirement hazard zone, and then the income phase. And the question is, where are you at in your season of life? And if you're 0 to 12 years away from retirement, you're in the retirement hazard zone. If you're already retired, you're in the income phase. And different tools and different annuities will fit better for you in different phases. So if you're in the retirement hazard zone, a better tool is going to be that hybrid fixed indexed annuity to project what your income is going to be and to protect what you have as you get closer and closer. If you're in the income phase, that's going to be a good tool for you as well if you need income now, or if potentially you're saving money and you might need that income for your spouse if you pass away and there's a lost pension or a lost Social Security check or an impact on your income. And so identifying where you're at in your season of life is very important. And then what we do is we say, okay, where does this annuity fit? And what are you trying to do with your overall nest egg? And so as we look at diversification, we diversify based on purpose of the money, not based on stocks, bonds, mutual funds, and what companies and where those companies are located. So the income basket is your safe basket. It's over on the left here, where your income, where you want this money to be committed to creating paychecks for you that you can never outlive, that will adjust for inflation, and also that will take care of a spouse if you lose a spouse in retirement. And so the income basket is a great place for these fixed index annuities, these hybrid annuities. You could put a variable annuity in there, but again, the variable perspective, it really belongs probably more in between the income basket, but maybe on the investment basket, because you have the ability to lose money inside that variable annuity as well. So when we sit down, and many of you have sat down and we've built income strategies for you, we look at the 5 different baskets of where should your money be going to accomplishing the goals that you have, and does an annuity fit for you? And if it does, where's the best place that fits, and what are the best ones and the best options we have to choose from to accomplish your goals and to protect what you have. So I'd already mentioned the income comparison. One of the things I've done quite a bit is looked at different annuities, and over a 25 or a 30-year retirement period, you really need to look at what's the potential total payout of that annuity compared to the other annuity, and many times one that is fixed compared to one that has the ability to grow and maybe start a little bit lower, it can outperform over 25 or 30 years by 3, 4, 5, sometimes $500,000, maybe even more. It just depends on how much. So it can be extremely, extremely significant. I do have a question that we will be taking. One of the questions was, what does while in deferral mean? In deferral means you put the money in the annuity and you're not taking income right now. You're just deferring it to let it grow. You're letting that money grow. You're letting that money compound. And 5 or 6, 8 years down the road, you'll then tap into it for income. So that's what deferral means. And yes, we will be taking questions. So if you want to just type those in, I can see those. Now's a good time for questions. So I'm watching very carefully my phone for new questions. No, I have not. All right, Mr. Producer, I think we're done. Hey, I want to thank you for joining me. Thank you for being patient for us getting started. We'll try and figure out all these buttons the next time we do this, and send out an email letting you know next time we'll be doing another of one of these educational seminars. Hey, if you know of anybody that you want to invite to that, or even you know somebody that might be wanting to know more about this information, or sit down to do a plan, feel free to let them know. We can come in, we can do private workshops and also private analysis, discoveries of where people are at, and really help them get into the position and the place that they want to be for the future. So you can also check out our radio show. It's every Sunday from 12 to 1 on KVOR, AM 740 KVOR. This weekend we are talking about, are you too diversified, and how diversified should you be? And if you've got any future topics, type those in. We'd be happy to entertain those and possibly do an entire event on that. All right? Thank you so much for joining us today. God bless. Have a great day.